All right. Today is Wednesday, February 16th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's start by this. We have two immediate concerns from the wall of worry. Number one is the Russia-Ukraine tensions. Number two, the hawkish Fed. Let's start with concern number one, Russia-Ukraine. We got some good news yesterday. Today we got even better news because the headline reads, Russia announced an end to its military drills in Crimea and says it's pulling its troops from the region. So for now, that places a lid on the Russian concern from the wall of worry. And I say lid, not a solution, because it is a fluid situation and anything could happen any day. But for now, the market is climbing the wall of worry when it comes to the Russian concern. As you might notice, we're already erasing the drop that we got last week as we heard that perhaps Russia is planning an invasion imminently. And the date was today, Wednesday, February 16th. Well, so far, as of the time of the recording of this video, we don't have an invasion yet. On the contrary, we have de-escalation. So that leaves the hawkish Fed as the main concern, perhaps the most active concern right now for market participants. We're not going to climb all the losses that we got since the beginning of the year, because these losses were due to the hawkish Fed. We're not going to climb all of these losses and make all-time highs until and unless the Fed reverses their hawkish policy. And they're not going to do that so long as inflation continues to surge out of control. And by the way, a lot of you say, what do we care if the Fed is tightening or not? Because in the past, the stock market performed okay under Fed tightening policies. Now, here's the problem. Last time we've seen such increase in interest rates was back in 2015 under Janet Yellen. Back then, we did not have inflation like we do right now. That's point number one. Point number two, the increase in interest rates back then, 2015 all the way to 2018, under Yellen, not Powell, was well transcribed. Meaning, we knew ahead of time that the Fed will increase interest rates by 25 basis points once in a while. So there were no surprises whatsoever. We knew exactly what the Fed is going to do, and indeed, the Fed did exactly that. But notice, all in all, when you look at the chart of the Dow Jones, we had a trend that goes all the way since the bottom from '09 in the aftermath of the financial crisis. Since then, the trend line was beautiful, all the way to 2015, when the market stalled. A matter of fact, broke the trend. So the market was ready to pull back and perhaps enter a bear market. Even though the tightening of the monetary policy back then was mild, only 25 basis points once in a while. But even with that, the stock market could not perform, and it was on the brink of turning into a bear market. And then came the rescue from the Trump administration via the tax cuts, the gifts to corporate America and the billionaires. So you had the monetary policy tightening, but you had the fiscal policy loosening. That was enough to give the market the fuel it needs to initiate another rally and recover. All the way till 2018, when Jerome Powell took charge of the Fed and decided to increase interest rates on what was known as the autopilot policy of increasing interest rates by 25 basis points on regular basis. The market did not like that and crashed 20% instantly. What do you know? Right away, since we did not have inflation back then, Jerome Powell walked back the autopilot interest rate policy. Matter of fact, he actually cut interest rates, and the market recovered. The lesson from all of this story is, for this market that we're in right now, 2022, for this market to recover, we need one of two things. Number one, the Fed walking back the hawkish policy. Number two, perhaps a loosening in the fiscal policy, either via trillions of spending or another package of tax cuts to corporate America. Now, here's the problem. Can the Fed walk back the hawkish policy? The answer is not really, because inflation is getting out of control. So we're going to scratch that one out because it is not a viable solution for now. What about the rescue from the fiscal policy? Can we get a multi-trillion deal to pass in infrastructure spending, for example? The answer is not really, because Manchin's not going to do it. And on top of that, more spending will equal more inflation and hence a more hawkish Fed. So that leaves tax cuts for corporations. Could that be the solution that we need right now? The answer is not really, because corporate profits at all-time highs. It will be political suicide to cut taxes for corporations right now when we have a high level of debt and high inflation. So again, I leave you with the question, what is left here to rescue this market? Let me know in the comments, but for now, I gotta move on to cover the main subject of this video. And here it is, in focus tonight. The myth of the so-called strong consumer. Is the consumer really this strong, or is the consumer just chasing inflation for now? Before we start, I need you to find your detective hat and put it on, because we're going to do a lot of investigation here to read through the lines and find out whether the consumer is really that strong, or do we have something perhaps more ominous hiding in the details. And let's start by this, the divergence between what people say and what they do. For example, yesterday we talked about consumer sentiment, specifically the American Association of Individual Investors. The reading of that sentiment indicator is pretty much at extreme bearish levels. Yet equities inflows remain extremely high. So while investors are saying, I'm bearish in the stock market, it doesn't look good for now, they're still flowing billions of dollars into the stock market. Likewise, when we talk about home builders, the housing market, well, home builders' confidence is pretty much in the toilet. It's a bearish readings because home builders are paying an arm and a leg for construction supplies and materials. On top of that, the waiting time to receive all of these supplies. Yet, at the same time, home builders continue to build more homes. Constructions are still underway. On the consumer side, when we talk about the housing market, the majority of Americans say now is a bad time to buy houses. The sentiment is pretty much at all-time lows. Yet what you see in the ground is people lining up for open houses, outbidding each other, and paying way above the asking price, in certain instances cash. So again, watch what they do, not what they say. And actually, the main question is, what is the reason behind the divergence between sentiment and action? Because even when it comes to the consumer, I shared with you the University of Michigan Sentiment Index, pretty much the lowest reading in a decade. On the other hand, today we got retail sales, and retail sales jumped higher, significantly so. So while the consumer says now it's not a good time to buy, and their sentiment is pretty much at all-time low, they're still spending a lot on retail sales. What is the reason behind this divergence? I will share my theory by the end of the segment, but today you might have heard on CNBC, Bloomberg, and the likes that consumer spending is surging higher and retail sales are intact. So all of these fears about a slowdown in the economy and perhaps the consumer is weakening and we're getting into stagflation, all of these fears are unwarranted for now. Matter of fact, Bank of America came out and said the consumer is strong, they continue to spend, and we're seeing these spending levels growing, not shrinking. So is the consumer really as strong as Bank of America suggests, or is there something else going on here? Because when the US Census comes out with the retail sales data, they give us a dollar amount, meaning in January 2022, retail sales were $649.8 billion. In December 2021, this is the revised number, spending was at $626.3 billion. So we have about 3.8% jump month over month. And the assumption here is the consumer is getting stronger. Here's the problem. Even when you hear data about household net worth, for example, they say that household net worth is at all-time highs. Americans are richer than ever. The problem is if you lump me, Bezos, and Musk together, sure, we're richer than ever before. Take Bezos and Musk out of the picture, and it looks drastically different. Similarly, when we look at retail sales data, if the pulse for the strength of the consumer is this, the dollar amount spent on retail sales, that doesn't give us a clear picture whether we're seeing more Americans spending on retail, or is it a few people spending more, or the other scenario, which is perhaps inflation is rising higher and therefore Americans are paying more whether they like it or not. Hence, retail sales data could be really misleading here, showing that the consumer is strong, but in reality, we're seeing people spending more due to inflation not due to the prosperous consumer and the booming economy, as they try to sell us pretty much every single day. Let's dig a little more here. The headline reads, retail sales surged 3.8% in January, much more than expected amid inflation rise. Okay. Online shopping contributed the most on a percentage basis, with non-store retailers seeing a gain of 14.5%. Furniture and home furnishing sales increased 7.2%, while motor vehicles and parts dealers saw a 5.7% rise. Here's the important part. Food and drinking establishments, considered a barometer for the thing-era economy, saw sales dip just 0.9% for the month, despite the major escalation in the thing cases fueled by the Pokemon spread. We have to talk like that because of the big tech tyranny. But regardless, here's what's problematic with this. If the consumer is so strong and they have a lot of cash to spend, the first thing people do is to go out to eat, spending money on restaurants and bars and services, etc., etc. So why did we not see an increase on spending for food and drinks establishments? Could it be because the consumer is not really that strong? They're only spending more on what they consider as necessities, and they're chasing prices higher due to inflation, and this is inflating retail sales data. But in reality, the consumer is not so strong, evident by the drop in spending in food and drinks establishments. That is one theory. The other theory is, which the pumpers of course like, is we're seeing a dip in food and drinks establishment spending due to the Pokemon variant. People are not going out to eat, but the consumer is fine. They have a lot of cash, evident by the spending in online shopping and furniture sales. So we have two theories here. Number one, the consumer is weak and just chasing inflation, evident by the fact that they're not spending in food and drink establishments. Theory number two is the consumer is strong, evident by the fact of online shopping, furniture sales, and the drop in food and establishment sales is due to the Pokemon. Let me know in the comments what you think. Continuing, consumers say that they're worried about inflation, but they continue to spend. PNC's chief economist, Gus Whatever, wrote, he also added, even taking into account the December decline, retail sales in recent months have been increasing much faster than prices, so households are purchasing larger volumes of goods and services, not just paying higher prices. Now here's the problem. Why is the consumer hoarding right now? Could it be because every time they wait for better prices, inflation moves higher, and by now they're convinced that you gotta hoard today because prices will get higher tomorrow, and hence we're seeing this surge in retail spending. It is consumers chasing inflation, not consumers spending more because they have more disposable income. Keep that thought in mind. Now, here's the alarming fact in all of this. Americans are increasingly using credit cards more than ever before. Matter of fact, the US has more credit cards than ever as issuance surged in 2021. Once again, the devil is always in the details. They show you retail spending, yet they don't show you if the consumer is spending using cash, debit cards, credit cards, or perhaps the buy now, pay later, or never model. So we have to investigate on our own to find out the truth. For example, when we look at new accounts opened for credit cards, the number is surging out of whack, and it took a massive leg higher last year. So we're seeing more Americans opening credit card accounts, using these credit cards to spend and chase inflation, and then rely on the false sense of security, meaning their job security, that they're getting a paycheck every single month, every single week, and they will be able to pay down those credit card loans. This is where it gets really dangerous. What happens if you lose your job? Because when the Fed tightens and starts to raise interest rates, the stock market will take a leg down, a massive one, perhaps crash. Stocks will lose a lot of value. Corporations will have to revert into capital preservation mode. What does that mean? Getting rid of excess spending, getting rid of excess employees, all of these remote workers that they don't need, but they're still in the payroll, say goodbye. Another problem, if interest rates move higher and you have this massive amount of debt, credit card debt, well, what do you think will happen? Right now, when the 2-year yield and the Fed funds rate is pretty much a zero, we're seeing credit card rates exceeding 15%. The interest that you pay for your credit card is over 15% in many cases. As interest rates move higher, the Fed funds rate, the 2-year yield, those credit card interest rates will move higher. from 15 to 20, perhaps 25, even 30%. Now you have this massive amount of debt that you racked up by buying all of these goods and services, chasing inflation. And oh, by the way, you lost your job. What are you going to do now? Here comes recession. So this is one risk in the economy that nobody's paying attention to right now. And oh, by the way, it gets even better when we count in mortgage loans, because since the thing began, over $1.5 trillion were added into mortgage loans. My question is, once again, what happens when you lose your job? Who's going to pay the mortgage? Who's going to pay all of these credit card loans? For now, credit card debt remains below the 2019 number, but it is increasing rapidly when interest rates are moving higher. So one thing you got to keep an eye on is this number, credit card loans. We're now getting closer to $1 trillion. And with inflation moving higher, we could get to $1 trillion really fast. So keep an eye on this piece of data. Another piece of data we got to keep an eye on is retail spending on food and drink establishments in February, because by February, the Pokemon SKUs will be out of the window. So if we see once again retail spending moving higher on online shopping, furniture, autos, etc., but now moving higher in food and drinks establishments, then we got a problem in this economy. We have people using credit cards, swiping those credit cards up and down, up and down, up and down to chase inflation. This is a bad recipe, folks. I really hope that I'm wrong in my assumption here. And of course, the Gen Xers, those in the 40s and 50s, are the ones who are going to get whacked the most because they hold the most debt. But you look at other age groups, for example, people over 70 years of age, it is really stunning that they still have trillions of dollars in mortgage still unpaid. We also have credit card debt moving higher among seniors. Whoops. Even when we talk about the Gen Zers and the young millennials, 18 to 29, look at student loans, that's moving higher. And oh, by the way, Joe says he's going to help you, but he's not. So the interest rate on your student loan will move significantly higher if you're a Gen Zer. What does that mean? Your quality of life, your spending power will be a lot less than the millennials, the Gen Xers, the boomers. So forget about home ownership. Forget about the American dream. Not going to happen when you have thousands of dollars in student loans and the interest rate continue to move higher and higher and higher. Now, let's dig in further. Whether the consumer is really strong or are they just chasing inflation? One of the most important companies when it comes to online shopping and the direct-to-consumer platforms is Shopify. Well, Shopify reported earnings today. And if the consumer is indeed strong, then we should see revenues for Shopify exploding higher and their margins also exploding higher because we're seeing more spending. The consumer is really strong, they're spending more. But there is no inflation problem. They're not chasing inflation because expenses are not rising higher for a company like Shopify. Well, let's see. Shopify stock crashed today, a massive drop. Why? Here's why. Let's look at the income statement for Shopify. Revenues year over year were up 26%. Okay, that means the consumers are spending more. Here's the problem. Look at the cost of revenues, up 37% year over year. And then operating expenses, a stunning increase of 73% year over year. All in all, the company lost income. They were down $371 million for the quarter, and therefore Shopify stock crashed. This is yet another indicator that the consumer is spending more to chase inflation. Otherwise, we would have seen revenues exploded in Shopify's earnings and expenses pretty much stayed the same, maybe increased slightly. This is not the case. Underneath the increase in revenue is a massive increase in expenses for the company. Likewise, when we talk about the consumer, underneath the spending numbers, the retail sales, we're seeing massive increase in debt, specifically credit card debt. In other words, inflation is killing Shopify. It is not an inflation-proof company. And soon enough, inflation will kill the consumer because interest rates will move higher while they're left with this mountain of debt that they racked in, swiping those credit cards up and down, up and down, up and down. And oh, by the way, what happens if you lose your income by losing your job? These are all risks that nobody's talking about right now. And listen to what Shopify says in this statement. Shopify says, our outlook for 2022 assumes continued secular tailwinds for entrepreneurship and digital commerce transformation against a more measured macro environment relative to 2021. More measured macro environment. Interesting. And mind you, when they release these statements, they have the stock movement in mind. They're not going to tell you the whole truth. So you got to read between lines. Anyways, they also say while we have or why we believe that the thing triggered acceleration of e-commerce that spilled into the first half of 2021 in the form of lockdowns and government stimulus will be absent from 2022. And there is caution around inflation and consumer spend near term. For the full year, we see economic growth supporting the continued penetration of retail by e-commerce. Shopify also adds, against these bigger picture, secular and economic assumptions, our financial outlook anticipates revenue growth for the full year 2022 that is lower than the 57% revenue growth achieved in 2021. And here comes the but. Please don't sell our stock. But still rapid and outpacing, blah, 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 who cares? You get the picture. We had a one-time bump in consumer spending fueled by stimulus that caused inflation, and inflation is sticky right now because, as I've taught you, inflation is a self-sustainable phenomenon. Once it's born, it continues to feed within itself and gets bigger and bigger and bigger. The problem is, and what's really transitory in this inflation, is consumer spending that we saw in 2020 and 2021, which caused corporate earnings to inflate, and now there's no way we can match the numbers from 2020 and 2021. What does that mean? Stocks are going down. Now you understand why Shopify stock crashed. They cannot match the numbers that we got from 2020 and 2021. And stock market investors continued to buy the stock with the assumption that the level of growth from 2020 and 2021 is sustainable. Well, we're now finding out that this is not the case. And here's my take. Bloomberg said in the reporting of retail sales data this morning, I'm quoting here, while the retail sales data are not adjusted for price changes, which makes the figures appear larger, end quote. How could you not adjust the data for price changes when we have a massive inflation? And this makes the retail sales data that we got this morning irrelevant. A matter of fact, if anything, it's a sign that the consumer is chasing inflation and not spending because they have excess reserves or they're feeling good about the economy. So again, when we talk about the divergence between what they say and what they do, it is not really a divergence. What they say and what they feel is actually their true sentiment. Their actions of spending in retail establishments is an act of desperation. Be it in home sales or retail sales, the consumer has no other choice but to chase these prices higher. Is there an element of irresponsibility and recklessness by the consumer? Sure. We're seeing this in the stock market, buying the dip all the time. But the majority of the picture is a desperate consumer chasing this inflation and hoarding before prices get even higher. Now, to confirm this case that I'm presenting right now, we need to look at credit card loans, the growth in credit card loans in upcoming months. We also need to keep an eye on the next reading of retail sales, specifically spending in food and drink establishments. And with that, folks, we're going to move on to cover the market formation for you. And we start with the performance of the indices today. And here we go. The Dow Industrial Average down by 54.53 points, or decline of 0.16%. The Nasdaq down by 15.70 points, or decline of 0.11%. The S&P 500 closing in the green, look at that, up by 3.94 points, or a gain of 0.09%. All in all, flattish activity, but the market was down big in the morning until the FOMC minutes rescue. We'll talk about that and a lot more in the charts analysis. But for now, let's move on to the sector's performance today. Leading the pack at number 1, capturing the gold medal, materials. Number 2 for the silver, energy. Number 3 for the bronze, REITs. On the other hand, the laggard of the day, technology. And again, notice how fast they bought the dip in the inflationary side of the market, energy and materials, and they dumped the high multiple sector of the market, technology. So for now, the reliable way to buy the dip in this market is to buy energy and materials, the two inflationary sectors in the stock market. Other than that, you buy the dip in tech or chips, you get excited for one day, what do you know, the next day they hit growth once again because interest rates are moving higher. Anyways, moving on to the advanced decline ratios, NYSE 58% advancing versus 40% declining. The Nasdaq 46% advancing versus 50% declining. Moving on to commodities, futures, believe it or not, crude oil prices were actually higher in the morning, but then they went down, closing in the red by the end of the day. And of course, hand in hand, the indices, the Dow Jones, Nasdaq, S&P moved higher, closing in the green. There is a correlation here. The market is starting to see the rise in crude oil prices as not bullish. If these prices move down, the indices move higher because inflation expectations move down. Anyways, the WTI was down along with the Brent, losing almost 1% apiece. Likewise, gasoline was down by almost 2%. Heating oil, similar story, down by a little over 2.5%. On the other hand, natural gas exploding higher again, gaining over 7% today. The volatility in natural gas remains stunning. What about softs? Look at this. Lumber continues to move higher and higher and higher by the day. They continue to buy the dip in lumber regardless, because home builders have no other choice but to buy. When we talk about this inflation and the consumer saying one thing and then doing the other, home builders have the same problem. They say that this is not a good time to buy materials and supplies to build homes. On the other hand, what are you going to do when you have insane demand in the economy? You got to buy, even with these expenses and these costs moving higher. The risk, though, for home builders is they're going to buy all of this lumber at higher prices, the copper and what goes with it. Then what happens after the Fed increases interest rates and perhaps it looks inevitable for now, push the economy into a recession? That demand will go poof, gone. And now the home builders are holding a massive bag. They have all of these houses that they want to sell and they spent top dollars to build them. Where is the demand? And I know what you're going to say. You're going to say, why not wait after the recession and then you buy all of these goods and supplies for a cheaper price? The problem is home builders been waiting and lumber prices went down, but then they moved higher again. So every time the consumer or the supplier wait for better prices, they get a nice hot pie in the face and prices move higher. So they have no choice but to continue to chase these prices higher. Today, lumber prices moved higher by almost 2.5%. Likewise, we have modest gains for coffee. On the other hand, sugar pretty much in the flat line. Yet we have losses here in softs led by cocoa, cotton, and OJ, be it modest losses for the latter too. What about metals? Decent day for gold. The old man is moving higher. Likewise, silver is also moving higher. Look at platinum moving to the upside big, gaining over 4.5% today. Likewise, palladium is moving higher, while copper pretty much in the flat line. Pay attention to the correlation between palladium and chips. I tweeted this today. In red, palladium. In blue, the SMH, the semiconductor ETF. If you recall, back in December, I said I am turning bearish against chips. Part of my thesis is the reverse head and shoulder formation in palladium. And indeed, palladium moved higher, chips went down. What is the chart looking like right now? Palladium forming a bull flag, the SMH semiconductors forming a bear flag pattern. So as palladium prices move higher, chips will go down, and hence the concerns with the Russia-Ukraine tensions. A lot of palladium comes out of Russia and Ukraine. A disruption of supplies will mean higher chips prices, which is, by the way, at this point, not good for these semiconductors manufacturers. Now, another commodity that we have to talk about is lithium and all of these EV manufacturing commodities, specifically lithium, nickel, and cobalt. All are moving in a stunning fashion to the upside, but the rise in lithium prices is absolutely stunning and unprecedented. We have never seen a commodity surge in price this fast, this big before. Never. Lithium is the new oil, and you gotta have an exposure to lithium in your portfolio, one way or the other. Buying the commodity or buying miners. If you see dip in miners, pure lithium miners, you gotta buy that dip. It has to be part of your portfolio because lithium is the new oil. Back to the futures. What about meats? We're seeing flattish activities for live and feeder cattle futures, but look at this. The new big tech, once again, lean hogs, moving higher and gaining a little over 1.5% today. Grains, mostly in the upside. Gains led by soybean meal, soybeans, soybean oil, corn, canola, while we have wheat, rough rice, and oats pretty much in the flat line. Pay attention to fertilizer prices because we talked about urea, we talked about nitrogen. Now look at this, potash prices are moving higher, big time. And as fertilizer prices move higher, so will grain prices. When grains prices move higher, so will the food price that you and I pay for on the shelves at the grocery store. Now, food is a necessity. We're not going to say or forego food because prices are moving higher. What does that mean? You go back to the source. Fertilizer prices are moving higher, so fertilizer stocks are good to hold right now, because what are they going to do? Are farmers not going to pay the higher price for fertilizers? Of course not. They have to. And of course, they're going to pass that extra cost down to you and I, the end consumer. So again, a good hedge against inflation is fertilizer stocks. Fertilizer just got even more expensive. Canpotex has agreed to supply China with potash fertilizer shipments at $590 a metric ton through December, which is more than double the price from a year ago, and the highest since at least 2013. Moving on to the big casino, the options market. What's going on here? The hottest table by far remains... it's not Apple. It's actually Tesla, the souffle. Wow. Look at Apple down. This is not a good sign for market bulls, folks. They're not buying call options. Anyhow, the hottest table by far is Tesla, with a little over 1 million contracts. About 59% of those were calls. Apple at number 2 with around 750,000 contracts traded today. About 59.5% of those were calls. Nvidia at number 3 with a little over 600,000 contracts traded today. About 64% of those were calls. What about the unusual activities that took place in the options market today? We start with the ticker SMH, the semiconductor ETF, which we just covered, by the way, in the futures market coverage. The chart shows a bear flag pattern, and somebody's betting on more declines to come for the SMH. Matter of fact, they bought the 235 puts for the expiration date, April 14th, with the expectations that the SMH will drop down by more than 16% by then. They paid about $4.50 apiece to enter this trade, all in all spending about $5.5 million. And what about the trade for the ticker MNST? I believe this is Monster Beverages. I could be wrong, but I believe this is the ticker. Anyways, they're making an upside bet here by buying the 90 calls for the expiration date, April 1st. With expectations that the name could pop higher by more than 8% by then. They paid about $2 apiece to enter this trade, all in all spending about $2 million. What about the trade for the ticker Airbnb for Airbnb? The name reported earnings last night and it popped higher after hours. I believe it closed in the green today, big time, over 3.5% gains. Somebody's betting for more gains to come by buying the $200 calls for the expiration date, February 25th, with the expectations that the name could pop higher by more than 7% by then. They paid about $1.30 apiece to enter this trade, all in all spending about $1.2 million. Continuing with unusual trades, what about the ticker SQQs? This is the inverse index for the Nasdaq, specifically the triple Qs. Somebody's buying calls here, meaning they're betting that the Qs will move down. In this case, they bought the 42 calls for the expiration date, February 18th, meaning this Friday. With expectations that the name could pop higher by more than 9% by then. They paid about 20 cents apiece to enter this trade, all in all spending about $100,000. What about the ticker SHOP Shopify? We just talked about the name in the intro of this video. The name is down big today and somebody's betting for more declines to come by buying the 700 puts for the expiration date, February 18th, meaning this upcoming Friday. With the expectations that the name could drop an additional 6% or more by then. They paid about $5.50 apiece to enter this trade, all in all spending about $2.5 million. And lastly, what about the ticker AMC for, you guessed it, AMC? They're buying calls here, the 23 calls for the expiration date, February 25th, with expectations that the name could pop higher by more than 17% by then. They paid about $0.50 apiece to enter this trade, all in all spending about $200,000. Moving on to the heat map analysis, what's going on here? Mixed picture across the board, but look at software, look at the high multiple names. They're getting whacked today. And the reason is inflation is moving higher, interest rates are moving higher. The expectations are that the Fed will tighten, and these names will get a bigger haircut. We have yet to see the reversion to the mean. The valuations are still too high. Even the Fed admits the valuations, the forward PE ratios, are simply too high in the market. What's performing is the reliable corners, the inflationary corners in the stock market, energy, materials, and of course the value, specifically the dividend-paying names, be it in big pharma, be it in staples, be it in REITs or utilities. We're seeing a flock here to dividend-paying stocks. Companies that produce a large amount of cash in the present time. What about the heat map for the ETFs? Again, muted. flattish, some gains here and there, but all in all, nothing significant at all, with the exception of the outperformance of gold. Whether we're talking about the GLD, the GDX, they all popped higher today, and my call is gold will outperform, and the reason is, it is a good place to park some cash right now. Are you going to park your cash in stocks? That's a lot of risk. Cryptos, maybe, but that's also risky. Bonds? No way. How about commodities? In the meantime, that works. But when the Fed starts to increase interest rates higher, the bubble in commodities will also pop, and then what? We're only left with gold as an option. When we look at international markets, all in all, flattish picture, be it in the green, with the outperformers being the EWZ, this is the Brazilian ETF, the EWY, this is the South Korean ETF, and of course the RSX, this is the Russian ETF, moving higher for the obvious reasons. Moving on to charts, and we start with SPY, the S&P 500 30 minutes chart. It looked a little scary in the beginning of the day because the chart went back to retest 443 over and over and over again, forming what it looked like as a bear flag pattern. And the assumption at the time was that 443 will not hold because the chart already tested that level yesterday. So why retest it again? Perhaps the market is not confident that this is solid support. And then what do you know? The FOMC minutes came to the rescue and the market took a leg higher, a massive one, firming the support of 443. The problem is that the FOMC minutes are lagging as an indicator because they were written before the CPI reading, before the unemployment claims, before the PPI. So the minutes were irrelevant to begin with, yet the algos were looking for anything to pop higher. And for now, the FOMC minutes are good enough. The support for now is 446.5, the resistance at around 451. And we are not overbought yet, at least on the 30 minutes RSI. Here's a daily chart for the continuous contract for the SPY, the S&P 500. What do we see here? The chart is trying once again to reclimb 4,472 as support. It did not make it today, but who's to say that the chart is not going to make it tomorrow? There is still plenty of time to reclimb 4,472. The momentum indicators are flattish for now, not on the side of bulls or bears. The volume is still off the highs. This is a good sign for the bulls. But again, it's a toss-up. Neither the bulls or the bears have the advantage for now. We're all waiting to see what happens. We talked about investors raising cash and waiting on the sidelines. This is the mentality for now. We are seeing day traders, option traders moving the market up and down on intraday basis, but we're not seeing serious commitment here in buying the dip or dumping stocks right now. Everybody's waiting and seeing what's going to happen when the Fed meets in March. In the meantime, if the sellers are done, then what is the path of least resistance until we get the March meeting? The answer is higher, not lower. The problem is, what if we have another piece of data comes out between now and then, and that piece of data points out to higher inflation, meaning a more hawkish Fed? The risk is simply too high to make serious commitments here, be it in buying stocks or even opening massive commitment in options trades, be it up or down. So be careful here. If you have options, be it calls or puts with the expiration date of March, if the market doesn't move in a big way, one way or the other, and the implied volatility moves down, you're gonna lose a lot of money holding these options. So you're better off closing them right now and waiting to see the market's next move. Or better yet, if you want to continue to hold on these options, open them for a longer expiration date. That way you're not caught by surprise if the market pops higher or drops down in a big way between now and then. Anyhow, let's move on to the Nasdaq, the Q's 30 minutes chart. Similar story with SPY. The chart moved down to retest 352. Why would you do that when you've already retested that number yesterday and the retest was successful? Why would you go down again? And therefore, I tweeted, I don't think that 352 will hold again. I think that the Nasdaq wants to go a little below that. What do you know? The FOMC minutes came to the rescue and we saw a massive pop out of 352. So for now, this number, 352, remains as support. On the other hand, the resistance at the very important level of 360. Now, here is a daily chart for the continuous contract for the Nasdaq's futures. Again, the magic number 14,445 is still intact. This is a good sign for the bulls. Yet the momentum indicators are stalling, so this is neutral. What about the volume? It is moving a little higher on the selling side. So the bears have a point, the bulls have a point. And then there is the momentum indicators on the neutral side. One way we could look at the chart is it is making higher lows and lower highs. In other words, this appears to be for now a triangle consolidation pattern, which is the neutral pattern indicating that the chart could break one way or the other, up or down. You're not going to know until you know, but losing the support of 14,445 will be an ominous signal for the bulls and a good sign for the bears. So watch out for that level. So long as it remains intact, the bulls are good to go. You lose that support, grab the diaper, grab the emergency kit because we're going down. What about the IWM, the Russell 2000 small caps from a 30 minutes perspective? Again, similar story. We have a revisit to the very important support line of 204.5, and then came the FOMC minutes and the pop, and hence this support is solid for now. And if this momentum continues, we're looking at 208 as resistance. The problem is, as I said, the FOMC minutes are lagging. Meanwhile, what's current is James Bullard. And guess who's speaking tomorrow? James Bullard. He could ruin everything once again, so watch out. Next, we have a daily chart for the Dixie, the dollar index. It moved down today, perhaps firming the bear flag pattern. It is still battling the level of 96, turning it from support to resistance, back and forth, back and forth. The dollar doesn't want to let go of 96 easily. But in the meantime, if you want to confirm whether the drop in the dollar is for real or not, look at the performance of gold. Today, gold popped higher, big time. It retested the sloping line of resistance, now support, and that retest was good to go. Gold wouldn't rally higher, the old man wouldn't pop higher if there is no conviction that the dollar is going down, at least in the next few days to the next few weeks. And here is a daily chart for the US 10-year yield, another pop higher. The momentum indicators remain elevated, but who cares about the momentum indicators and the technicals for that matter when the fundamentals are supreme when it comes to the chart of the 10-year yield? Expectations of higher inflation and more interest rate hikes will move the 10-year higher. The interesting development that we got today is the following. The 2-year yield moved slightly down. The 10-year was a little higher to flattish. So we saw a little bit of steepening in the yield curve, perhaps on the heels of retail sales data, but as we've talked before at the beginning of the video, that could be misleading. What about the TLT weekly chart? Good news for the TLT bugs. We have a retest of 134.5 pretty much to the penny. Matter of fact, look at the daily chart. Here it is. So the question now is, can the TLT pop higher? If that is the case, then the 10-year yield will move down, perhaps retag the support of 1.94 or even go down all the way to 1.77, although I don't see it going down to that level without a catalyst. Anyhow, what about the VIX 4 hours chart? We're now getting a confirmation that perhaps the pop in the VIX is over, but we're not out of the woods yet because look at the MACD indicator. We're seeing red impressions on the histogram, confirming the pop in the S&P and the drop in the VIX. The problem is, the MACD indicator could curl its way higher again if we see another pop in the VIX. And this could happen easily these days. So the bulls are not going to feel out of the woods yet until and unless the VIX closes below 20 for the week. Keyword for the week. But for now, from the information that we have for now, who has the advantage, the bulls or the bears? The answer is the bulls, because the VIX is curling down, the MACD is showing red impressions in the histogram, yet the bears would counter, who cares about all of this because 20 is still intact? We have yet to break the support of 20. Likewise, when we visit a 4 hours chart for the VXN, the VIX for the NASDAQ, we have yet to see red impressions on the histogram of the MACD, but we're getting closer. What does that mean? The bulls are gaining a lot of momentum here, and perhaps the Qs will move higher in the next few days. The problem for the bulls, and we're talking about market bulls here, who's to say that the VXN is not going to move higher again? After all, we are still trading above 27.5, which is the equivalent of 20 on the VIX, so anything could happen. And who's to say that this is not a bull flag pattern for now? Who's to say that this is not an ABC pattern? We're forming the B leg, but soon enough we're going to pop in the C leg formation. The bulls will not feel safe until and unless this chart closes the week below 27.5. I'm not in a rush to buy anything here. I'm only going to buy the Qs and the SPY if these charts, the VIX and the VXN, close below 20 and 27.5 for a weekly closing. Moving on to Apple, a daily chart. What's going on here? The good news is it is still holding at the support of 172.4. You can round that up to 172 1.5. The problem is, the chart has yet to break above the double top pattern. The momentum indicators remain neutral, not moving higher or to the downside. The volume is moving slightly higher today, but we don't have any indicator one way or the other to say whether Apple is going to pop higher or drop down. For now, we are in purgatory. What about Tesla? Perhaps we can find a decisive move in this name. Well, it is moving higher from an hourly perspective, and the bull flag pattern remains intact. So the next step is perhaps a pop higher to retest 995 as resistance. Yes, I am holding put options. I'm gonna close if this bull flag plays out. I'm gonna wait for a reversal signal and then open more puts, perhaps for a longer expiration date. So be careful here if you're holding puts. If Tesla closes the week above the trend line that you see in yellow, you gotta close your puts specifically if they are within the expiration date of March. If you have an expiration date of April and beyond, you're good. Maybe you want to add more after the failure at 995. But for now, holding these March puts, if Tesla closes above the trend line for the week, is just a little too risky here. And remember, this is the Tony Montana stock. It doesn't matter what bad news you throw at it, until and unless, of course, the guy with the sunglasses with a big shotgun comes from the back and seals the deal. What is the shotgun that will take Tesla down, you might ask? I have no clue at all. But I feel that something is brewing here with this lawsuit between California and Tesla regarding racial discrimination. I feel that there is a bomb that's about to hit. We'll see. But the bad news that we got for Tesla today is, forget about the affordable car, the $20, the 20,000 range affordable car by Tesla. And of course, this car was aimed for the Indian market, but that's not going to happen right now. So this is a massive loss for Tesla in gaining market share, because the Chinese manufacturers are offering really good cars at a better price. But perhaps this is not doable for Tesla because look at lithium prices. Look at nickel prices, look at cobalt, look at copper, aluminum. Perhaps there is no way you can manufacture an affordable car, an affordable EV, I should say, if you are a US manufacturer. And by the way, why is Tesla still keeping the Model S? Maybe you want to scrap that one. Just end the production of Model S because nobody's buying it. It is a crappy car with a lot of problems, and I used to own one, by the way, but everybody's buying the 3 right now. Why not scrap the Model S, be a little more efficient here, and increase your margins? We'll see. Moving on to tulips, BTC, Bitcoin. It is slightly down today, but the retest to 42,000 for now still intact, and we're waiting for more buyers to show up so the chart can pop higher. If the buyers don't show up, then we're going down below 42,000 once again. But for now, the bulls are still in charge. I'm smelling a pop here in BTC, and by the way, I tweeted this today. I've been critical of Bitcoin for a long time, but it is becoming an important tool to circumvent the tyranny. And we're talking about the situation in Canada. Very unfortunate situation, by the way. Disgusting what they're doing over there. I mean, even if you were against the truckers to begin with, and you want them out, are you really comfortable with one guy who, by the way, barely won the elections with about 32% of the vote? One guy gets to enact this much power? It is absolutely alarming, and the sad truth is it's coming down here. They're going to do the same thing. If you counter the narrative, you're a bad guy, you're a propagandist, you're a terrorist, and we have to lock you up from any banking access, and the only viable alternative for now is Bitcoin. But watch out, they might ban that too if people indeed were able to circumvent the tyranny via Bitcoin. More Bitcoin news. You might have catched Charlie Munger speaking today, and of course, he doesn't like Bitcoin and spoke negatively about it. But we also have JP Morgan. JP Morgan says cryptocurrencies will suffer massive losses as the Fed ends crazy quote-unquote speculation by hiking rates. Next, what about AMC and hourly chart? Again, so far so good. This chart is not showing weakness for now. If anything, it's showing a saucer bottom. You can use a 2 hours or 4 hours chart and you can see a cup and handle formation. All of these are good formation indicating that AMC is going to pop higher to retest 21 as resistance once again. You can look at this chart another way. I didn't mark it for you, but this is, for now at least, it appears to be a bull flag pattern, gathering the energy to pop higher above 21. And then we'll take it from there. Now, if Bullard comes out tomorrow and crashes the market, then all bets are off, but the technicals for now favoring the apes. And lastly, here is a bonus chart for you, the ticker GNRC, Generac. Somebody asked me about this name today on Twitter because it reported earnings. Should we buy? Is it time to buy the dip? Let's recall what I said about Generac just a few weeks ago. Take a listen. Here's the last one yet to pop. The ticker GNRC Generac oversold reading and it could pop higher again. But bear in mind, the chart has broken the consolidation range to the downside and it had a false breakout to the upside before that. This is a clear indicator that the chart will trend to the downside from this point on. So be careful here. It might rebound on oversold basis, but the long-term picture on this one has turned bearish. So be careful. And again, if you took my advice, I've saved you about 30% worth of losses here. But let's look at the chart from a weekly perspective. As you can see, the RSI, the MACD, they're all curling their way higher. This is a bullish sign, not a bearish one. The problem is, even if this chart curls its way higher, absent of recapturing 400 as support, who's to say that this is not going to be a formation of a head and shoulder, and then we see another leg down, ending the rally in Generac. Let's use Fibonacci for help here. You can ride this one higher all the way to 355, and then you might find some solid resistance. If you must buy the stock right now, sure, go ahead, but make sure that you buy some puts too, perhaps at 250, 240, whatever you're comfortable with, in case the stock goes down. It is not an absurd valuation, but the environment all in all in the stock market remains really risky. You don't want to make a commitment of buying a stock right now until you see how the market is going to react after the March Fed meeting. Anyhow, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the weekly jobless claims. We have building permits, housing starts, the Philly Fed Manufacturing Index, but most importantly, James Bullard of the St. Louis Fed is speaking tomorrow. All eyes and ears will be listening to James Bullard. Lastly, what do we have on the earnings calendar? We have Walmart. Again, it's a good pulse on retail spending, inflation, the consumer, yada, yada, yada. We'll take a look at it once we get it. But for now, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.